When combined with just your normal financial activities, managing your cash flow needs to be right up there as one of your top priorities. So at FWO Chartered Accountants, we specialise in working with law firms, and particularly from the profit and cash flow strategies perspective. I've been working with firms up and down the east coast of Australia, and more recently extending that out into South Australia. Generally, I work with firms in that 1 to 4, 1 to 5 principals size space, and what I see in those firms is pretty much the same thing. Very good lawyers, but when it comes to business management and the strategies that really make the difference in law firms around their improvement in profitability and cash flow, let me say that they're a little bit short on on achieving their outcomes in most cases. So with some very simple, focused strategies that you can implement in your firm, and some of those I'll be running through with you today. If you do this, then it can have a profound impact on your profitability and your cash flow. So without further ado, let's get into it. I'm wanting to start today a little bit differently than I do with previous webinars. And I'm just wanting Christina to take you through a quick Q&A. We're not going to share the results of these polls, but it's more so just to spark your thinking before we get into the detail, so that as we're going through, it might resonate a little bit more deeply with you. And these questions that we're going to ask are those key activities that you really need to be thinking about in your business to get different cash flow outcomes. So, Christina, over to you. If you can just please run through the questions.
Absolutely. Okay, so the first question. I religiously provide clients with a cost agreement, including an estimate of my fees. I'll launch that one. You've got multiple choice questions there. Give you a few moments on that.
Okay.
Second question is, I include a plain language cover letter to my cost agreement outlining my estimate, billing and payment terms. I'll launch that one for you. Third one, I include fixed billing intervals in my cost agreements as well as clear payment terms. Fourth question, I have a system to ensure the billing is made in accordance with the cost agreements by administration. Next question, I have a specific resource for data collection. I have a defined and structured debtors collection system. And lastly, I review my WIP and debtors and transfer cash to my general account weekly as a minimum. Over to you, Matt.
Great, thanks, Christina, and thanks everyone for just going through and answering those questions. So as we progress through the rest of the webinar, just think back to some of those questions, and ideally as we work through, I think you'll find that there'll be certain actions that you'll be able to take as a priority over others, identifying holes and where improvements required that can go back to those questions. So let's get into it. So what we're talking about here is the financial management focus of your business, and in focusing on your financial aspects of your business, you've got to look at what those key activities are that drive improvements in profitability and improvements in your cash flow. No holes barred, no punches, not pulling any punches here. The majority of firms are quite ordinary when it comes to their financial management. Excellent lawyers, but financial management, often those actions and processes and systems in the firm is designed more for the client's benefit, not for the financial benefit of the business. And at the end of the day, you're operating a business, you're not operating a charity, and all of your clients are engaging with you as a business. So what you need to do is you need to take very much a tight, strong financial management focus in your business and have it as a priority. Because if the profits aren't there, the cash flow isn't there, then really what's the use? Life's just going to be hard. So when you're focusing from a financial management point of view, there are two key numbers and key areas that you need to focus on. First of all, from a profit perspective, you need to actively manage the relationship between your revenue and direct labour costs. So the higher your profitability, the better chance you've got of improving cash flow. Now, if you've attended my last month's webinar, we focused on the key drivers of improvements in profit. And if you'd like to get a copy of that webinar, please just reach out and we'll send you a link to it. But if you've already attended that webinar, you'll have a copy of that link already. And so, to refresh your memory, I'd encourage you to go back and have another look at it. So the reason we focus on the relationship between revenue and direct labour costs, just to quickly summarise, is that labour cost is our input cost. It's what's employed to generate our revenue. And what we don't do is we don't spend near enough time making sure our systems and processes in the business are designed for us to produce predictable revenue. So hop into that previous webinar and have a look at some of the ideas in there and then get away and implement them. From a cash flow point of view, though, what we need to always focus on is shortening that period of time between when a cost agreement is signed or when you've got instructions and when the final cash is collected on the matter. So I call this the cash gap. And if you look at the period of time between when the cost, your cost agreement is that starting point, or your instruction, that's when you start work. So what you're actually able to do is you're able to control the timing of when you bill and actually collect cash. You actually can control how a client engages with you, and you do. But usually, and that's what you've got in your cost agreement, whether clients read, it's a different story, hence a very plain language cover letter to say these are the important things that you need to understand about working with us as a business. But if you can shorten that period of time between when you start the work and you get paid, cash flow is going to improve. And that's just about what are your policies and procedures around shortening that time frame. It's not just about finishing the work. So if we think about the process that happens during this period of time when we do the work. So the first thing is we engage the client, and it starts with a cost agreement or get instructions, or there's a disclosure document that's provided, and away we go. So there is an engagement effectively of clients, and with that engagement you're saying, this is the work we're doing, this is how much we estimate it's going to cost you, or this is the amount it's going to cost you. And then if we do that work and it becomes out of scope, then we'll re-engage you, and this is the amount you need to have in trust, and this is the amount that we're going to bill you in these billing intervals, and this is how you can pay us. So you engage the client and basically set those rules right at the very beginning. Then what you do is you do the work. And the key to driving profitability in your process is to maximise your revenue and minimise your labour costs. So it doesn't mean go and cut your labour, but it means maximising the amount of revenue you generate for the minimum amount of time that's being spent by your direct labour, your solicitors, your principals, your paralegals, your legal secretaries. All of those people can get the maximum amount of revenue generated from the minimum amount of labour costs that's spent. Again, go back to our previous average rate revenue webinar, and we'll go into that in a bit more detail. But the greater the amount of revenue you generate from the minimum amount of labour cost will produce a greater profit per matter for you, which gives you a greater chance of improving cash flow to start with. So you do the work. Then when you're doing that work, it's time to bill it. And the key to focus on your key process that you need to focus on is to make sure you don't write off the time that has been allocated or entered against that matter off the client. Look, chances are there's already time that people have worked on that hasn't been entered. So if they've put the time on the clock, bill it. And bill it regularly. It doesn't have to wait till the end of the matter. You're actually in control of the timing of billing. In most cost agreements, it says, unless it's a deferred matter or a matter that's a staged-based billing matter, but most cost agreements say we're going to bill you on a regular basis, or we're going to bill you on a monthly basis. So if it says that, do it. Now, billing is a very, very important process, and this is what I see as the number one. Get some structure around this, some better structure around this. This is one of the number one things that really improve profitability, not just because the bill gets out, but the more regularly you're billing clients, the less likely you are for write-offs to occur, the faster the collection process is. So just on that no write-off policy. So what you've got to remember is that the majority of matters that are open, majority of files that are opened by your clients, are opened for clients that are either returning clients, they're existing clients that have worked with you before, or they are coming from your referral network, which is either existing clients, your personal networks of family, friends, business associates, or your professional networks might be from other lawyers or accountants or financial planners or whoever that professional network is. Now, what happens with those referrals is that most of those clients have already made their mind up they're going to buy from you before they come and engage and reach out to you. They've made their decision. Your conversion rate of inquiries with those people, which is by far the highest number, percentage of matters that are opened in your firm, your conversion rate is very high from inquiry to file opening. Very different to a lot of other sales and conversion rates when it comes to sales. It's very high. So those clients, as I said, they've made their decision to buy from you. They're really not sure what they're wanting to buy from you. Usually it'll be something to do with a conflict activity, either a conflict prevention or conflict resolution solution that they're after, based on the type of work that you do. But they really don't know how they go about that, so they're asking you to solve that. So they've made a decision to buy from you, usually before they meet with you. They don't really know what it's going to cost them until you issue them with a costs agreement or an estimate. But thirdly, they're already making that decision thinking that you're expensive. Nobody has got a view, no one in the world has got a view that lawyers are cheap. So they've already got the view that you're expensive. So don't disappoint them. Bill the work that you do. The key is to how you manage that relationship with them on the way through and do that work as quickly as possible and a high level of client service. But to start with, bill what you do. The bigger issue with billing is usually with principals and solicitors in firms, not with the clients. That's been my experience and also the experience of a lot of my clients. So we'll come back to some processes around billing in a little bit more detail shortly. The next thing is how you collect your cash. So you need to have structured processes in there. First of all, agree on your trust account policy. If you require money in trust at the front end, make sure it goes in there before you start the work. And if you have that, have a top-up policy so that you've got to make sure that with the balance of the work and every time you raise a fee, that if that trust account is depleted in terms of the cash that's there, make sure that it gets topped up to your required balance. And then secondly, you've got to have a dedicated resource. Make sure you've got somebody in the business that their job is every week to focus on debtors collections and manage them through the process. Then once you collect the cash, you keep re-engaging the work and keep doing this work and billing the work until it's all finished. And then client comes back to you at a later point, away you go again. So we're going to look at each of these different sort of processes along the way and talk in a little bit more detail about what I see in firms, but also around some practical actions that you can implement that work. Again, nothing I do here is based on theory. This is all about what firms have already implemented and are getting the benefit of. So again, let's focus on the two key numbers for driving profit and cash flow. The first one is average rate. The second one is revenue lock-up percentage, which is where we're going to be spending our time today. So very quickly before we move on, average rate is calculated by your revenue divided by your direct labour paid hours. So those hours are principals, solicitors, legal support. And what it does, it measures the actual amount of revenue earned for every hour of direct labour cost paid to earn that revenue, whether at work or billed to the client. So whether it's in work in progress or billed to the client. So it's whether the people are at work or whether or not it's been billed to them. It's just how many hours have you paid. From a revenue lock-up percentage, you look at your debtors and your WIP, which equal your lock-up, and you divide that by your revenue and then turn it into a percentage. What that is a measure of is it calculates the amount of revenue that you've generated, so either billed or unbilled to clients, looking at a percentage of your revenue that you make. So this is what we could turn into cash, but we haven't yet. So when we're focusing on these two numbers, what we want to see is we want to see an increasing average rate, because that means you're getting more profit out of your business. So just by focusing on that relationship of revenue to direct labour costs, and we want to see a reducing revenue lock-up percentage, because that means more of the work that you've got is then turning into cash, because those WIP and debtors balances are lower. Increasing revenue, which is measured by average rate, reducing lock-up percentage, which is measured by a reduction in the amount of your WIP and debtors relative to your revenue. What that equals is more cash, which is the outcome we're looking for here. So, a few things that I want to just run through to think about when we're implementing change. How do we do that? What do we need to focus on? So if you've attended my webinars in the past, we would have seen this little flow chart many times. So when you're implementing change, what we want to do is we want to produce a different outcome. So Einstein's definition of insanity is doing the same thing over and over again and expecting a different result. So we've got to think about that result, the outcome, and think about what we've got to do to drive a change in that outcome. So what creates an outcome is the behaviour. So it's the behaviour of people. Think about all the different people that are in your firm and the way that they do things. And unless you've got really strong systems in your business and they're tight, everybody does everything the same way, it's very difficult to manage that behaviour. But if you're looking at that behaviour, what drives it? It's the structure. So I just referred to systems there. So whatever your structure is in your business is around how you do things, what's expected to be done in your business, and how people live and breathe those structures. That drives their behaviour, which drives the outcome. So the point of this flow is to say, if you want to get a different outcome, you've got to go and do some different structuring at the front end to produce some different behaviours to get that outcome. So if your structure is very loose, if your systems and processes are very loose, what it produces is discretionary behaviour. So if you're relying on all of your team members if we're talking about this from a cash point of view, if we're relying on all of our team members to raise their own bills and do that when they think it's an appropriate time and collect their own debtors, and they do that when they have time to do it. It's all discretionary. Then the outcome we're going to get is unpredictable. Very difficult to get. Very difficult to get strong cash flows. But if we've got a tight structure, it's defined, and then we live and breathe it. This is how we do things here. The behaviours that happen are predictable, because we say we're billing on this day, billing happens on that day, and it's for every bill, it's for every client that's a client of the firm, that's got a matter, that is on a monthly billing program. This is the day they get billed, and we're going to bill whatever's in WIP, and that's how it happens. Now, you might think that's just impossible. Well, it's not. It's very, very easy to do once you make the choice. And then what you get is you get predictable cash flow outcomes and predictable billing outcomes, as an example. So in implementing change, the critical thing you've got to focus on here is looking at what outcome you want, and then look at what structure you've got in place already that's driving the behaviours to produce that outcome. Then go and focus on what you're going to change structurally. What are the systems we're going to change? What are we going to do differently? With that financial management focus, so that we have a single standard system for managing billing and collection across the business. Okay, so the killer of profit and cash is one thing in every law firm, and that is discretion. So solicitors, authors, fee earners, person responsible for a matter, whatever you call them, they are good lawyers, they are not good financial managers. So again, Einstein's definition of insanity: if you've got ordinary cash flow and you want to improve it, and you just keep harping on about the same things, do your bills, get them done, collect your amounts that are greater than 30 days, and nothing happens, you've got to go and change that system. And the key to it is remove discretion. Your financial system in your business is probably the number one system in your business that cannot have discretion. If it has discretion, it has to be on an exception basis, not on the majority basis. So it only has to be where there might be an approval for working outside of the system. But that is the key thing you've got to do, is remove discretion. Focus on the majority of transactions, and the majority of clients will pay you on time and will pay you their fees because they already think you're expensive and you're solving a conflict-based issue for them, and they've made the business decision to buy from you. So work with that knowledge. Remove your internal discretion around how your processes work from a financial point of view when it comes to billing and collections. Remove that discretion, and overnight you will get a shift in your profitability and cash flow. So this is what I see in firms. So the first thing that I see is poor engagement with clients re billing and cash terms. Okay, so people don't like to talk about the money. Get the money out of the conversation, out in the conversation right at the very beginning. So this is how we do it. This is your estimate of what your fees. This is how we're going to bill you. This is how we're expecting to pay you. You need to put this money into trust. You need to pay us if there's not enough money in trust within 7 days. If we get to 14 days and you haven't paid us, we will be putting our tools down, and we will not be doing any more work on your matter until it is done. So understanding that, make the client understand what it is. Now, that's very normal. You might think that's unusual, but it's very normal. Clients are just making a purchasing decision. You're not family, you're not a friend. Clients are engaging you in a business transaction. It's just like buying a pair of shoes. It's just like buying a car. It's like booking a holiday. Yeah, very different. The world that you're talking about is stuff that's not as fun as any of that. But hey, it's still a business decision, and these are the terms of engagement. You can't go and book a holiday and book a plane fare to go on a holiday without paying for it. You've got to pay for it. Same thing here, you've got to pay for it. So I see extremely poor engagement. This is not, the better you are at this, the easier your financial management is. I see extremely poor WIP management. Firms focusing on the wrong thing when it comes to cash flow. They're focusing on, you've got to get this amount of money collected, or you've got to focus on this level of amount that's billed. The key thing that you've got to be focusing on is twofold to really drive improvements in cash flow. Maximising the amount of revenue that's added into WIP for the work that's done. Different topic, that's very much around average rate and profit. And then focusing on the conversion of that WIP, because at the end of the day, what you've got sitting in WIP is your revenue that hasn't yet been billed. So the focus in the firm needs to be on WIP, really focusing on what's the value of time added into WIP, what are our billable hours and how we're going. Forget about billing. Have conversations about WIP entry, and then have conversations about WIP exit. That's the billing. Set systems up to get better billing. Get your WIP down as low as possible. Focus on that. How do we manage our, also with WIP management, how do we manage the workflow? Who does what work so that the matters are progressing? Is that at the discretion of the fee earner, or are they managing and working on their matters that are required to be worked on that week? One, not just to progress the right matter, but also to make sure that there's the ability for the firm to bill that work so that the firm hits its financial outcomes. Removing fee earner discretion, rebilling timing and amount. Okay, so these are the rules that we have in the business around how we bill and when we bill. Most of the time, it is totally up to fee earners to drive that process. Some firms give fee earners every once a month on the last day of the month, here's your matter list, tell us which ones you want to bill, and then they go and raise a pre-billing report or something. But if they don't, if the fee earner decides not to bill it, well, then we'll just roll that through to the next month. Well, that doesn't work. That's not how you need to financially manage the business. These are the rules of how we work in the business. This is what's going to be billed and when it's going to be billed, and you're not going to get a choice on what's going to be written off. That's an exception to the rule, not the norm. So most firms have that discretion. You've got to remove it. Their focus of fee earners is on being a good lawyer, not on good, strong financial managers. In billing, a fee earner who's doing that passes their own value judgment onto what it's worth, and they've really got no idea, because the value to the client is the only thing that's paramount, not the dollars that you're billing out based on an hourly rate at a certain charge rate, or the fixed fee, or whatever it is, however you bill it. It's the value that is attributed to the work that you're doing by the client. Internal processes are not aligned to the costs agreement. This is one of the fundamental issues that needs to be tightened up in firms. Cost agreements will say, we will bill you on a monthly basis. We'll bill you on a regular basis. But then it's totally ignored. You've got to remember, the clients are actually signing the cost agreements to say, yeah, we're agreeing with those terms. They mightn't read it, but it's in there. This is why you do a plain language cover letter with them that says, this is when we're going to bill you. This is the timing. They'll at least read a covering letter. They won't read the whole agreement. So do that as a minimum. But what you need to do is make sure that every step along the way that the costs agreement is adhered to. If it talks about money in trust, make sure that's the case. If it talks about top up into trust, make sure that's the systems have that in there. If it talks about billing on a fortnightly or on a monthly basis, make sure your systems have got the triggers that ensure that those matters get billed. Or make sure that your cost agreement, which will say if it's out of scope or goes beyond our estimates, we'll re-engage it. Make sure you've got a system in place that makes that happen. All of these things are just what the clients agree. What if firms have a lack of debtor collection structure? They don't have a system They don't have a system in their business that says this is the process of how we're going to collect. When it goes outside, when it hits 7 days, if that's our terms, you know, what happens at that point? When it goes to 14 days, what happens? When it goes to 30 days, what happens? They don't have that data collection system in place. And if they do have it, they don't have somebody within the firm that's empowered to implement it. And the number of times I hear, no, we refer it, you know, to the fee earner or the author to go and collect it, and they never do. Or our process is before we contact the client, we need to check with the author as to whether or not that's appropriate. And the author says, no, not yet. I'm just about to finish this off. You know, whatever the excuses are, which is as long as my arm, and so that process stops. Cut all that out. This is what the client's agreed to. Get the fee earners out of there. Get them. Get a dedicated person that's their job every week to make sure that that system is being followed. And then really an unenforced trust account and unenforced trust act top-up policy. If you're going to use a trust account, live and breathe by your trust account. No money in trust, tools go down. No payment of the fees, tools go down. You know, this is just strong financial management, strong financial management systems. So I'm just going to give you a little bit of an insight here into, you know, the impacts that you can have by focusing on this revenue lockup policy and how reducing your WIP and debtors, focusing on those activities to drive improvements in your revenue lockup and the impact it has on cash flow. So this is just a little calculator that I've got. You know, it's referring to what the average rate side of things from previous webinars. So we're just extending that somewhat. So looking at this calculator here, if we've got the same amount of profit, and if our lockup percentage is currently at 33% of our revenue, which is just $600,000 divided by $1.8 million, then it means we've got 33% of our current lockup is cash that we can convert. So let's just say, based on that level of profit that we've got, you know, this current target, it's exactly the same. With this lockup that we've got here, if we were to get what's been billed collected faster by regular billing, by improvements in our processes, by trust account policies, and if we could just get that down, let's say to from 50 days down to 45 days, it automatically, on the same profit, produces an extra $26,000 worth of cash flow. Okay, so that doesn't seem like much, but if we amplify our profitability so that we're actually, from the work that we're doing day in, day out, even without reducing our debtors days, we're holding still 19% of our revenue in debtors days. But if we could get that, say, up to 45% productivity, so that the hours that people are including on their timesheets is only a 26 minutes per day more, not by doing more work, but just recording better work with some simple strategies, then it can produce an extra $260,000 worth of fees billed in a year, which is an improvement in an average rate of $19, but also by maintaining a 45-day lockup, gives us an extra $283,000 worth of cash. Let's also focus on our charge rate and getting the right people doing the right work. And let's say we got a small increase in that, say to $430. So again, we get some more improvement in profitability, we get some more improvement in our average rate, but we're collecting our debtors a little bit faster. So we're getting $305. And let's say also that we can get our write-offs down to 6%. You know, $337,000 in cash. So I haven't got time to sort of work through in this particular webinar, you know, what strategies that we can show you by driving better downtime in billing and the implications of, you know, billing more that's in WIP and how that flows into debtors, and if you could get your debtors down, say to 30 days, doing all those things, what impact that has on your cash flow. There's a whole other, complex formula that goes into that. But needless to say, by making small improvements in both profitability and in cash flow, you get improvements in extra cash. So again, let's go back here and I drop these back to where they are. If you can drop, in just by getting some tighter billing processes, getting that 50 days down to 30 days on the same profit that you're making, by just getting your lockup percentage here down now to 71, be about the same. So your lockup percentage then reduces as a percentage because you've got the same revenue, but your lockup's gone from 600 to 500. You're getting an extra $100,000 worth of cash flow into your business. So again, it's not done by chance. It's done by structured and systematic changes to how you do things in your business. So let's go back and have a look at now how we go about doing it. So this is how it should work. So what you've got to do in your firm is you've got to have a standard billing policy across the firm that aligns to your cost agreement. First and foremost, look at what your cost agreement says, and then that's how you set your actions up. That's how you set your system up. If your system says we're billing monthly, then bill monthly. If your system says we've got trust account policy, this is how we do it. If your policy says that we're going to bill you at the end of every, cost agreement says we're billing you every week, no, it won't, then you set it up like that. And then what you do is once you've got your system set up, you follow them. What you should do then is set your billing by weeks. So one of the biggest problems that firms have is that fees all happen at the last day of the month, or in some cases, within the week after the month. So everything's just delayed. But and you've got this massive administration impost on the business, and you've got this massive distraction away from doing client work, and you've got this massive delay in actually getting money into your bank account because you're delaying it. So change it. Choose to set up different billing schedules so that from an admin point of view, it's spread across the month. If it's spread across the month, then you are going to be able to have more sustained and better cash flow that comes in more regularly, as opposed to sometime after the end of the month when everything's gone out. So look at doing that, maybe by department, maybe by principal, maybe by fee earner, depending on your business and how it's structured. Second thing is remove the preparation of draft fees by the fee earner. Make sure your fees are drafted by an administration team member, and that those fees are drafted based on that billing cycle, based on your standard billing processes per your cost agreement. Have them drafted either automatically by the software, which can be done, or also or by an admin person. So if you've got your triggers as to saying this is a monthly bill, as an example, it gets billed, on this date or during this week on the third week of every month, or then those fees automatically get drafted, not by the choice of the fee earner, but because that's the policy of the business. So they get drafted. So let's say for that department, it's their billing week, or that principal and their billing week. Every morning, every Tuesday morning, those fees are drafted, and they're not itemised. So it's just a very simple narration in relation to the fee, and then they go for approval to the approver to authorise it on Tuesday afternoon. That fee approval's got to happen by the end of the day on Thursday. Now that's just giving them a bit more time, but they know it happens that time, so that they have the ability to, they still have to approve it. They still have to make sure that it's appropriate, but there's no checking here as to whether or not that fee aligns to what the cost agreement said or the estimate. All it is what we've got in WIP. So we're going to raise a draft fee for it. That then is up to the fee earner to take responsibility for it. The rules are, if you don't approve this by 5 p.m, or you've got a write-off that's approved on this fee by 5 p.m. on a Thursday, we're just going to issue it, because that's the appropriate process. That's what we're going to do. That's what the client has said. So if in that time, if it's out of scope, then out of scope, higher than the estimate, then that fee earner needs to re-engage the client, and then that fee gets issued. So then the admin person issues those fees Friday. So it doesn't sit there within the fee earner's approval bucket so that it never goes out, or a fee gets approved and it's sitting there to be sent out, but the client starts getting a debtor's statement 3 weeks later and they haven't even received the fee yet. So there's a very simple process around billing and how it should work to get structure within the firm. The key is to make sure that you have structure around the timing of billing. You remove the discretion from what fees to bill and drafting those fees, that function away from the fee earners. But they still need to approve it, they still need to review it, but you have structure around write-off and issue. So there are some not negotiables that need to happen in this process. First of all, you've got to have a clean open matter balance list. If you're managing via WIP, what's the value of time we've entered into WIP? That's what's going to be raised in a draft fee. Have a clean open matter balance list. So you've really got to stop, go and revisit what your matter balance list looks like and tidy it up. Close the matters that shouldn't be in there. If there's WIP in there, clear it out. That shouldn't be in there. Clear it out so it doesn't exist. Because you want this structured approval, draft fee, timely billing process to be as seamless as possible. And the more that somebody's got to say this is just not right, it breaks down. But once you've got that clean matter list, which you should have for managing your work anyway, you can then really automate this process. So that's a not negotiable. So here's an example of your standard. Here's your standard billing policy. So again, if we go back and we say here, create a standard billing process across the firm that's aligned to a costs agreement. From my experience, there are 3 different types of matters that relate to a billing process. The very first one is your time or item fee billing. That's what happens on a monthly basis. So it says in your costs agreement that we're going to bill you each and every month for the work done. So what you do is you tag in your system that it's a monthly bill. You might have a billing timing trigger as well that says for that person, for that person, that department, whatever it might be. For all of the matters that are monthly billing, we run our draft fees on this week. But instead of just draft fees for every item in there, you might set a policy that says for anything that's greater than $500 of WIP and disbursements, that's marked as a monthly fee. That's what we're going to get billed. If it's less than $500 and the matter is still in progress, then it just gets carried forward to the next month. If the matter's finished, then you got to bill at the end. You got to bill it, make sure it gets billed. And you should really bill that when the matter's finished, not just waiting for your monthly billing cycle. Secondly is where you've got a fixed fee or a staged-based fee. So it might be that you issue a fee to a client for probate when the probate's issued, as an example. So there's a trigger that's got to happen in the business that says probate's been granted, let's issue the fee at that time. Or if you're conveyancing, that will be, right, settlement has occurred, we've raised the fee and it gets issued and collected. So these are at fixed intervals that happen during or at the end of that matter. And lastly, there's a deferred fee, and they get feed at the end. So with the deferred fee, very important to keep your clients abreast of what what their spend is that they're going to owe you at a point in time. So it's a good idea just to every month drop them an email saying this is the value of where your matter's up to. But the vast majority of firms work in the time and item fee or time billing, monthly billing cycle, and that's what their cost agreements say. So your fixed stage-based fees and your deferred fees will be whenever they're going to be. You know, a key thing is to really move away from deferred fees as much as possible if you don't have the right funding mechanisms in the business to fund your working capital to take that deferred fee. But what I see where most profitability is in firms and where I see the biggest discretion being applied is in the time or item fee based matters. So, as an example, set your billing weeks. You know, it might be week 1 is family, week 2 is commercial, week 3 is estates, week 4 is property. So only have a 4-week billing cycle. So that means in some months, some teams are going to get billed twice a month. But months are irrelevant. It's just a 4-week billing cycle. And so when I call monthly, let's call it a 4-week billing cycle. And that's what you have in your cost agreement. We're going to bill you every 4 weeks. So you do that, it just stretches out the administration burden, and it also starts getting the billing happening on a more regular and frequent basis so that clients are happy. So again, just showing you that example. What's the fee approval process? So by getting bills actually drafted by admin, make sure they happen, but it's still the fee earner's responsibility for managing that WIP. They need to re-engage the client, they need to approve it, but within the policy of the business. So Tuesday by noon, fees to be drafted by admin and finance. Tuesday to Thursday, there's a fee approval process, and then Friday they get issued. And the more you just get into this routine and it rolls, the more predictable your level of billing is, because you then focus on the amount of WIP that's getting added. And if it's getting added into your work in progress on those matters, and then you've got a structure for billing it out, you're going to move more towards that predictable billing and then cash flow cycle. The more regularly you bill clients, the better the faster they pay. So here's a couple of rules when it comes to billing. If it's in WIP and disbursements, it gets billed. It's non-discretionary. Write-offs are an exception and will need approval. So has the client been re-engaged to start with? Is the write-off more than 10% of the total fee estimate for the matter? If it is, then you've got to get it approved. If it's not, bill it, because it's just an estimate. And has the write-off been approved by an authorised person? So that's the billing rules. So just to quickly summarise, look at what your cost agreement is. What are those rules are? If those rules don't suit the business, change your cost agreement. Change it so that it has these key things in there: money in trust, systematic regular billing on a 4-week cycle, expectation that if there's no money in trust, you pay within 7 days. We reserve the right to down tools until you have your account in order. So do that. With your cost agreement, send a plain language cover letter out with it under the cost agreement, so that it's at the forefront of people's minds, no more than 1 page, forefront of people's minds, these are the terms of the agreement. Then make sure your billing system is set up so that it aligns to the cost agreement. If it says it's going to be every 4 weeks, then you've got a structure that creates every 4 weeks a bill being raised, and have your limits in there. Also for your fixed and stage fees, and also for your deferred fees. Make sure that there is a write-off policy in place. What's in WIP gets billed, and you can only have your write-offs approved by an authorised person. Usually keep that to 1 person who is the best biller in the firm, because as soon as you remove discretion away from write-offs and it's not allowed, automatically, and it becomes an exception, automatically you should be generating more revenue. Your clients, remember, think you're already expensive. Don't disappoint them. And then from the collection point of view, have a dedicated person that follows your process. That is not your fee earner. So just a few ideas there. Focusing on your revenue lockup percentage. What you've got to do is you've got to get as much revenue into WIP as possible, so work being done. Then you've got to get it out of your WIP as fast as possible so that it goes into debtors. And then you've got to get it out of your debtors as fast as possible so that it goes into your bank account. Higher profitability, lower revenue lockup percentage, so improving average rate, lower revenue lockup percentage equals more cash. So again, this has been done time and time again with my clients, and it's not theory. This actually does work, and it's not something that's just happened, in the last, 6 months. This is the process that we've implemented with clients year in, year out for years. Those ones that follow it and have that rigor and control really have a different sort of level of profitability and cash flow. So I'm challenging you then to take that step, and it's more of an issue for you than it is for your clients. Just got to educate them that this is how we do business. So as usual with all of our Grow Your Firm webinars, if you'd like to catch up to have a review of your revenue lockup percentage, the first 5 people to email me today to matt@fwoca.com.au. I'll get you to send me some information on your levels of revenue and also your WIP and debtors figures, and then we can have a 45-minute online meeting.